There is a lever inside the Federal Reserve that most Americans have never heard of. No announcement, no press conference, no headline saying quantitative easing, just a quiet mechanism buried inside the plumbing of the global financial system. And right now, it may be activating. Somewhere between Tokyo and Washington, a decision is being made that could determine whether the world's largest bond market holds together or breaks. And if it breaks the way some analysts believe it could, gold and silver may only be getting started. Stay with us, because by the end of this video, you will understand exactly what this mechanism is and why it matters more than almost anything else happening in markets today. Welcome back to Precious Metals Intelligence, the channel built for people who prefer to understand the forces moving markets before they move, not after. If you are the kind of person who reads the footnotes, who wants the reasoning and not just the headline, you are exactly who this channel was built for. Before we continue, if you've spent years building what you have and you'd simply like a second sober set of eyes on where the world's monetary system is heading, consider joining the group of viewers who follow this channel closely. There's no pressure here. Just consider it an open invitation to keep thinking alongside us. Somewhere in the waters near the Strait of Hormuz, tankers move slowly through one of the most important shipping lanes on Earth. Nearly a fifth of the world's oil passes through this narrow passage every single day. And in recent weeks, that passage has become the center of global attention. Reports began circulating that military strikes were being planned. Then, just as quickly, those plans appeared to pause. Leaders spoke of new negotiations. Officials hinted that a deal to keep the strait open could arrive within days, maybe even hours. Oil prices, which had been climbing sharply, suddenly reversed course and dropped. On the surface, this looked like good news. Investors exhaled. Headlines declared that the crisis was cooling off. But a small group of analysts noticed something strange. While oil prices fell, something else did not fall the way it should have. Long-term U.S. Treasury yields stayed high. To most people, that phrase means very little. But to anyone who studies markets closely, it is one of the most important signals in the entire financial system. Treasury yields represent how much it costs the U.S. government to borrow money over time. When yields rise and stay elevated, it means investors are demanding more return to hold that debt. It means they are nervous. It means they see risk. And normally, when a major threat to global oil supply fades, that nervousness fades too. Yields tend to ease alongside falling oil prices. This time, they barely moved. This disconnect is what caught the attention of analysts watching the story closely. If the danger had truly passed, why did long-term borrowing costs remain stuck near levels not seen in almost 2 decades? Something did not add up. Some believe the answer lies in trust. Not trust in oil supply, but trust in the promises being made about it. Markets have seen this pattern before. Tensions rise, strikes are threatened. Then, at the last moment, a deal is floated and prices fall in relief. But the underlying conflict is never fully resolved. It simply pauses. And on the ground, the situation remains far from calm. Reports continue to describe ships being struck by projectiles while crossing through the strait. Military bases in the region reported attacks days after the de-escalation headlines began circulating. To the analysts paying closest attention, this was not the behavior of a conflict that was ending. It was the behavior of a conflict that was simply taking a breath. This is why some believe the recent drop in oil prices should be viewed with caution rather than celebration. It may reflect optimism about diplomacy. It may reflect market algorithms reacting instantly to headlines. It may even reflect quiet efforts by policymakers to calm energy markets before they spiral further. But whatever the cause, one fact remains unchanged. The bond market is not fully convinced. And that matters more than most people realize. The 30-year Treasury yield is not just a number on a financial chart. It is a measure of how much confidence the world still has in America's ability to manage its long-term debt. When that yield refuses to ease, even during a period of falling oil prices, it raises an uncomfortable question. What does the bond market see that the oil market does not? For decades, energy shocks and debt concerns were often treated as separate stories. One belonged to geopolitics, the other belonged to fiscal policy. But in this moment, they appear to be moving closer together. A disruption in the flow of oil threatens to push inflation higher. Higher inflation threatens to keep interest rates elevated for longer. And interest rates that stay high for longer place enormous pressure on a government already carrying record levels of debt. This is the quiet tension sitting underneath the more visible headlines about ceasefires and negotiations. While the public conversation focuses on whether tankers will move safely through the strait, a smaller group of observers is focused on something deeper. They're watching the cost of America's long-term borrowing. And so far, that cost is refusing to come down. What happens next may depend on events far from Washington. It may depend on decisions being made in Tokyo, where another economy is facing pressure of its own. Because, as the next part of this story reveals, the strain building in the bond market is not only an American problem, it is becoming a global one. There's a number that rarely makes headlines, yet it may be quietly shaping the next chapter of the global economy. It does not trend on social media. It does not appear in most morning news segments. But among the people who study markets for a living, this number is treated as one of the most honest signals available. It is the 30-year U.S. Treasury yield. To understand why this number matters so much right now, it helps to understand what it actually represents. When the U.S. government needs to borrow money, it sells bonds to investors around the world. In exchange, it promises to pay that money back over time with interest. The 30-year yield shows how much interest the government must offer to convince investors to hold that debt for 3 full decades. When confidence is high, that yield tends to stay low. Investors feel safe lending money for a long stretch of time because they trust the system will remain stable. But when yields rise and stay elevated, it often means something else is happening beneath the surface. Investors are asking for more compensation because they see more risk. Right now, that yield is sitting near levels not seen since before the 2008 financial crisis. And this is where the story becomes especially important. Because the world in 2008 and the world today are not carrying the same weight. Back then, the United States had a large amount of government debt. Today, that debt has grown dramatically. Interest payments on that debt alone have now crossed $1 trillion a year. That is not the cost of a specific program or a single policy. That is simply the price of paying interest to those who hold America's debt. This detail changes everything about how seriously elevated yields should be taken. A high yield in a low debt environment is uncomfortable. A high yield in a high debt environment is something closer to a warning light, and the effects do not stay contained inside government finance. Long-term Treasury yields act like a foundation underneath many other borrowing costs throughout the economy. Mortgage rates tend to follow them. So do corporate loans, business expansion costs, and the price of financing large real estate projects. When this foundation shifts upward and stays there, the pressure spreads outward, touching families, businesses, and industries far removed from Washington. This is why some analysts describe elevated long-term yields as a slow-moving story rather than a sudden one. It does not cause panic in a single day. Instead, it quietly raises the cost of doing almost everything that depends on borrowed money. Over months and years, that pressure can build until it becomes difficult to ignore. On the other side of the world, a very different kind of pressure has been building. It does not involve tanks or tankers. It involves a currency slowly losing its footing, and a government caught between two choices that each carry serious consequences. The Japanese yen has weakened dramatically, falling toward levels not seen in roughly 4 decades against the US dollar. For a country that imports most of its energy from overseas, this is not a minor inconvenience. It is a direct hit to daily economic life. When the yen weakens, every barrel of oil purchased from abroad becomes more expensive, not because oil itself has changed in price, but because it now takes more yen to buy the same barrel. This creates what some analysts describe as a double burden. If global oil prices rise at the same time the yen is falling, the cost is felt twice. Once from the oil market itself, and once again from the currency exchanging it. Japan has found itself caught in exactly this kind of squeeze. Faced with this pressure, Japanese policymakers have limited options, and none of them are simple. The most obvious solution would be to raise interest rates. Higher interest rates typically make a currency more attractive to hold, which can help stop it from weakening further. In most circumstances, this would be a fairly straightforward response. But Japan is not in a typical circumstance. It carries one of the largest government debt loads of any major economy in the world. Raising interest rates aggressively would make it far more expensive for the Japanese government to service that debt. In trying to defend its currency, Japan risks creating a second crisis inside its own bond market. This is the trap. Do nothing, and the currency keeps weakening, making imported energy more expensive and squeezing households and businesses. Raise rates sharply, and the cost of managing government debt becomes dramatically heavier, risking instability in a different part of the financial system. It was against this backdrop that something unusual took place. For the first time in many years, the United States joined Japan in stepping directly into currency markets to help support the yen. This kind of coordinated intervention is rare. It tends to happen only when policymakers view a situation as serious enough to require direct action rather than simply talking about it. Even more notable was how that intervention was carried out. Rather than selling dollars directly to buy yen, reports indicated that euros were sold instead. To most people, this detail might seem small, but to those watching currency markets closely, it suggested something important. It suggested that managing this situation had become more complicated than a simple two-currency exchange. Multiple currencies, multiple economies, and multiple pressures were now intertwined in the same problem. Why does any of this matter to someone outside Japan? Because Japan is not a small, disconnected economy. It is one of the largest holders of U.S. government debt in the world. For years, Japanese institutions have purchased enormous amounts of U.S. Treasuries, helping to fund American borrowing. If Japan urgently needs dollars to defend its currency, one available option would be to sell some of those Treasury holdings to raise cash. On paper, this sounds manageable. In practice, it could create serious ripple effects. If a major holder of U.S. debt begins selling large amounts of Treasuries, it can push bond prices down and yields up, adding even more pressure to the very bond market already showing signs of strain. This is the connection that ties Japan's currency problem directly back to the story unfolding inside U.S. Treasury markets. A weakening yen is not simply a Japanese issue. It is a potential trigger for further stress in the global bond market at a moment when that market already appears fragile. Policymakers are fully aware of this risk, and it is precisely this awareness that has pushed them to search for an alternative path, a way to help Japan access the dollars it needs without forcing it to dump its Treasury holdings onto the open market. That search has led to a tool that most people have never heard of, buried deep within the mechanics of the Federal Reserve. It does not carry a dramatic name. It does not appear in headlines, but it may be about to play a very significant role in how this entire story unfolds next. Deep inside the machinery of the Federal Reserve sits a tool that almost nobody outside of financial circles has ever heard of. It has no dramatic name. It does not appear in political speeches. But in recent weeks, this quiet mechanism has moved from the background of monetary policy to the center of a much bigger conversation. This tool allows foreign central banks to hand over U.S. Treasury securities they already hold and receive U.S. dollars in return on a temporary basis. Once the arrangement ends, the securities go back to the foreign central bank, and the dollars return to the Federal Reserve. On paper, it looks like a short-term exchange, nothing more. But the purpose behind it is significant. Consider Japan's situation from the previous part of this story. Its currency is under pressure. It needs dollars to help stabilize that currency. One option would be to sell some of its enormous holdings of U.S. Treasuries directly into the open market. But doing so at a large scale could push bond prices down and yields up, adding even more strain to a Treasury market already showing signs of stress. This lesser-known Fed tool offers another path. Instead of selling those Treasuries outright, a foreign central bank can pledge them to the Federal Reserve as collateral and receive dollars in exchange. No large sale hits the open market. No sudden shock ripples through Treasury prices. The country gets the dollars it needs, and the bond market avoids a fresh wave of selling pressure. At first glance, this appears to solve the problem cleanly, but a closer look reveals something more complicated. When the Federal Reserve creates new dollars to buy Treasuries directly, that action is widely known as quantitative easing. It expands the Fed's balance sheet and increases the amount of money circulating through the financial system. This newer tool works differently in structure. Instead of buying Treasuries outright, the Fed is lending dollars against them temporarily. Technically, that is not the same thing as quantitative easing. Yet many analysts argue the practical effect can end up looking remarkably similar. If this facility is used only occasionally and in small amounts, its impact stays limited. But if foreign central banks lean on it repeatedly, and if those temporary exchanges keep rolling over again and again, new dollars keep entering the financial system just the same. The mechanism may be labeled differently, but the outcome on overall liquidity can start to resemble the very thing policymakers are avoiding naming out loud. This is the detail that has caught the attention of a growing number of market watchers. A central bank does not need to hold a press conference and announce a new round of quantitative easing to expand liquidity in the system. It can happen more quietly, through a facility with a technical name, built for foreign governments facing currency pressure, expanding step by step without a single dramatic headline. Step back and look at how each piece of this story connects. Tension near a critical oil corridor threatens global energy supply. That tension pushes inflation expectations higher and keeps long-term Treasury yields elevated. Japan, already carrying enormous debt, gets caught in a painful squeeze between a weakening currency and rising energy costs. To avoid worsening its own debt problem by raising interest rates, and to avoid destabilizing the U.S. Treasury market by selling bonds outright, Japan turns to this quiet Fed facility instead. Each response appears reasonable in isolation. Yet together, they form a loop. Energy pressure feeds bond market stress. Bond market stress feeds currency pressure. Currency pressure feeds demand for Fed liquidity tools. And that liquidity, once it expands far enough, starts to resemble the very monetary intervention that started previous chapters of financial history. Nothing about this has been formally announced as a shift in policy. No official has stood at a podium and used the words money printing. But for those willing to look closely at how the pieces move together, the pattern is becoming difficult to ignore. And that pattern raises one final question, the one this entire story has been building toward from the very beginning.